Yes. We are seeing longer horizons. 3-year deals are going to 5 and 5 that's going to 7. And a lot of syndicators are stuck in a bad spot. They might have been paying distributions, they might have been paying the pref and everything, but if they sell today, they might sell at a loss of 10, 20, 30% to the asset value. So the investors are happy getting their 8% preferred return. But if they sold today, they might take a loss of 10, 20, 30% on their principal.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. Today's guest, Ken Naim, is a commercial syndicator focused on value-add office, industrial, and retail. Welcome to the show, Ken.
Thank you. Happy to be here.
Now, when we talk specifically about the industrial space, I've seen a trend. I don't know if it's just because it's more popular now online or if there's more people getting into it or a little bit of both. It seems like there's a lot of interest in industrial right now.
Industrial has been hot pretty much for 20 years now. There's been a big push for industrial spaces, office spaces. It got overbuilt for a little while, and it took probably a 10, 15% hit for a couple of years, and now it's back on track and growing. And it's been so hot that it's been hard to find deals in that area, and especially value add deals, or a term I like to use, value included deals, where there might be not a lot of value to add, but you're buying it at significant discount that the value is already built into the purchase. So those deals have been really hard the last few years, and we haven't bought a lot, but we're starting to find some deals now. So this is the market for it, if you can find the right deal, of course.
Now, specifically industrial, I think encompasses a lot of different areas of real estate itself. There's segments within industrial. For myself and for folks who haven't done a deal in this space, what all does industrial encompass?
It starts off from light industrial and warehousing, where the actual facility, they don't do any real manufacturing there. It's just storage of parts or equipment, and it could be as small as 5,000 square feet, 10,000 square feet. And it can go all the way up to heavy industrial manufacturing in the hundreds of thousands, millions of square feet. It could be an Amazon facility with over 1 million square feet. So there's a very wide range, and it services pretty much any company that doesn't really have to be customer facing, where they have storage needs, where they have product needs, where there's logistics out of there. It even includes cold storage, where you have these huge refrigerated facilities for fruits or vegetables or other perishable products. So it's a very wide range of things. My focus is more on the smaller side, let's say 5 to 100,000 square feet, light industrial, warehousing. where you don't get into too much manufacturing. And I like that area because it's very plug and play. You can take one tenant out and replace it with someone else. If I have a 400,000 square foot factory for cement, it's very hard to repurpose that for
Yeah.
another tenant if they move out. Now, you might buy it super cheap, but you might never be able to rent it. It might take you 5 years, 10 years to find a tenant, and you might have to spend a fortune repurposing it for something that size. So that's why I like the more warehousing, where you can take out one 20,000 square foot tenant and put one or two tenants in there to fill up the space quite
How,
easily.
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
how often are there similarities between, leases in the industrial space? Is there like a standardized lease, or is each agreement with each tenant very much specific to that one situation?
Well, no two leases are really identical in commercial. They can be very similar, but you're always going to have nuances between them. But we do have a standard lease, and for these smaller spaces, especially in Texas, 99% of the lease is the same. It's a standard Texas bar leasing contract. And then the the big action happens in the addenda, where you specify the differences between the contracts. So every contract, every lease is going to have, okay, this is the rent, this is the late fee, these are the penalties, these are what allowed or not allowed. But in the addendum, it says, okay, this is a triple net lease where the tenant's responsible for all these different items. Okay, are they responsible for maintaining the HVAC, or are they responsible for replacing the HVAC if it dies, and so on and so forth. So that addendum also specifies free rent, for example, which is not part of the standard if they get a month free or something like that, which is not always the case, but sometimes. You could get a TI. Oh, they want us to install a 10-ton crane in there, and that's part of the deal. So that addendum covers most of it, but that addendum is typically a page long or 2 pages long. So it's not a huge lease, and it doesn't have to be custom except in extraordinary circumstances.
Now, for finding these deals, I can imagine there's a number of different ways where you might have come across industrial deals. People might be bringing them to you. It might be a seller who comes direct to you. I'm sure brokerage is a big part of this as well, and having a relationship with
Mhm.
with a broker. But for folks who are looking at getting started in industrial investing, right? I'm imagining they're probably going to be looking at smaller deals, and they're probably going to be checking places. The first thing that comes to mind is like the Crexies of the world, LoopNet, and so forth. How are you finding deals?
A lot of deals start with Crexi and LoopNet, and we try to find good brokers in certain areas, and they're hard to find. Like most professions, only a small percentage of brokers or any other profession are really, really good at it. A lot of brokers will just go to CoStar, get a list, all the listings in the area, and just send it to you. That's all information that I can get myself. I don't need a broker for that. Okay. We want to build relationships, get off market deals. We want to get them before they're listed. Times when we have to, when before 10,000 people have looked at it, because at that point it's really hard uh, to find a diamond in the rough if 10,000 people already
That's
looked at
right.
it. So, so we do outreach. There is cold calling and mail and email. and all of that. But we try to make relationships with attorneys that real estate attorneys that know stuff that are going for sale and might put us in contact sooner. Divorce attorneys, probate attorneys. We like to talk
Right.
to real estate brokers, find the really good ones, the ones that they're getting the calls because they're already well known in that market. So they're getting the calls right away, or they'll know that, oh, this is a vacant building and I'm negotiating a lease for it. And I know the seller wants to sell.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
So the second that lease is signed, we can go in and buy it already without the risk of lease up. Or if they know they're desperate to sell and they're trying to lease it first, we can make a cash offer to buy it vacant if we know that it has a strong possibility of leasing in the next few months. We don't like taking on completely vacant buildings with a ton of risk, but for the right price, we will work it out.
How often are you buying these deals when they're fully occupied versus when they may have some vacancy or maybe substantial vacancy?
In this market, it's hard to find real deals. You have to make the deal. So a lot of times we'll find something listed online and it's not a deal. You know, at with bank financing, bank rates, with appraisals and standard down payments and standard everything, the numbers are just not good enough for us. But we talk to the broker, we find out how flexible the seller is, see if they'll offer some kind of seller financing or what the value add is on the property. So if it's already leased up and there's no value add, it comes down to the terms. So we might offer them their price, but get a longer amortization period or get interest only, get a lower interest rate. Like one of the deals we just closed, typically that market is 15 to 20-year AMs. Well, we got a 22-year AM with a 6% interest rate instead of banks in that area are typically around 7, 7.1, 7.2. So those little differences on these, $5 million deals, it all adds up. And all of that gives us enough margin that we can have a good return for our investors and have enough margin on top of that so we can keep something ourselves. And
Historic, Historically, sorry to cut you off, but historically, I've seen what feels like a rise in seller financing across the board. I mean, everything from single family up to commercial. Have you seen this as well, or have you seen seller financing been around for a long time and it may be catching more steam right now, but it's been around for a while?
seller finance has been around for a very long time, but it's usually rare. And I've almost never closed deals with seller financing. It either doesn't make sense, they want too much down. But nowadays, bank financing is getting tough again because so many banks are underwater with multifamily deals, with commercial deals. A lot of people went into these with no experience and now they're getting bit. And now, consequently, the banks are suffering, or at least their at risk portfolio is getting bigger. So they might not default, but the banks don't care if you actually default, they care if you're at risk for default. And that's a very big distinction that a lot of banks have a lot of money at risk and they're becoming very conservative. So a lot of sellers want to sell, but banks will not approve it or they won't underwrite it properly, or they'll try to bring down the price too much that they'll only approve a certain balance so people can't afford to pay their price. So a lot of times to get their price, it makes sense to seller finance. And so we're seeing a lot more sellers open to that concept.
I've also heard that in the syndication space, there was a lot of people, and I guess there's two sides to this story, but there was a lot of people who took out variable rate debt, specifically in the multifamily space, which is, I know, not your avatar of investment right there, but uh, really, and they didn't foresee, the future uptick in rates, and so they was kind of the perfect storm of a lot of things. You had in
Correct.
multifamily, rates double, materials increase, rents stabilize or go down in some places like Austin, Texas, right? And then you also had changes in the law and changes in the environment and political climate. So you're looking at all these factors and you're saying, wow, it's not an easy time to be a multifamily syndicator specifically, right?
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Yeah, even in the commercial space, our debt is typically fixed rate debt, so we didn't suffer as much with the variable rates. But a lot of properties that were purchased 4 or 5 years ago for 3.5% interest, their loans are now coming due because they're 5-year mortgages typically in the commercial space. So the 5 years is pretty much up. So all these properties are now being refied, and luckily interest rates have come down about a point in the last 6 months or so. So they're being refied at 6, but if you bought at 3.5 or 4, it's still a 50% increase to your interest rate. And that results in about a 35% increase on your mortgage payment because the principal pretty much stays the same. So if you're paying $20,000, $30,000 a month mortgage, all of a sudden it goes to $30,000 or $40,000 a month. That can pretty much wipe out a lot of cash flow for these loans these deals that are marginal. If you
Yeah.
were at 1.25 DSCR to start, you might only be at 1.1, and you might have to bring cash to the table to refi. So a lot of sellers don't have that, or they don't want to put more money into an existing deal. So they're kind of forced to sell it because they don't want to contribute, especially if they haven't grown in equity. So especially stabilized deals where there was no value add, you're kind of forced to sell them at this point.
Now, has this also had the effect of, maybe some syndicators looking at longer horizons and longer time frames as opposed to 5 years? Maybe say, hey, we may have to be in this for 10 years or 7 years. Has any of that happened?
Yes. We are seeing longer horizons. 3-year deals are going to 5, and 5 that's going to 7. And a lot of syndicators are stuck in a bad spot. They might have been paying distributions, they might have been paying the pref and everything, but if they sell today, they might sell at a loss of 10, 20, 30% to the asset value. So the investors are happy getting their 8% preferred return. But if they sold today, they might take a loss of 10, 20, 30% on their principal. So they go, why should we do that? Let's just hold it, get our 8% until the market recovers. So we're seeing a lot of syndicators struggling with that. And syndicators are struggling because they might not be making money on the deal. They might be paying the pref to their investors, but they're not actually pulling out anything themselves. So they're doing all this work and they're not getting paid for it, and they might never get paid for it. But their reputation's also on the line. So it's better to pay investors 8% rather than take, we lost money on a deal at 10 or 20, 30%. And
Yeah.
that's a good scenario. If it's only 10, 20, or 30, and not some deals that I've heard of that are minus 50, minus 100% on
Oh
principal.
yeah. I think there's a lot of that, and I can tell you, as someone who's licensed in Texas, there's apartments. This sounds unbelievable, but I've been saying this a lot recently. There's apartments that are doing 2 months free rent, 2 months free rent plus some type of financial incentive on top of that, like an
Yeah.
Amazon gift card, right? And that's not just in one
Move
metro.
in, they'll pay
Yeah,
your moving fees. Yeah.
when was the last time we heard of this? I mean, I feel like it was not that long ago where there was just no available apartments in so many markets, and now that there's this surplus, you're now seeing urgency on the other side. Hey, we got to get tenants in here. And I've actually said this to a buddy of mine. I said, when they're saying that it's however much percentage occupied, is it really? Is it really? How many of those units maybe need some work, and maybe they're not ready for someone to come in, but they may be damaged in some capacity? So they're saying that 90% occupancy. Is it 90? Is it 70? What is it? And you can imagine those investors and those syndicators who own those deals, they want people in those units.
Yes. And it is a big struggle out there. It's just, it, we're actually have still a shortage of apartments, but we also have a shortage of affordability. And that's the problem. Like, we have enough people for every available apartment, but prices have gone up so high in so many different areas that people can't afford to rent. So two people are living in the same apartment, in the same home, or they're moving back in with their parents or with their friends or something because they just can't afford to live on their own
Yeah.
nowadays. Incomes haven't risen as fast as prices.
We are coming up on time here, Ken. Any new projects that you're working on? And then as well, what's the best way for folks to get in contact with you or your team?
So we just closed two projects in Odessa, Texas. One in December, one in February. We have one or two that are still in the works right now, and these are all brand new construction in the last 3 years, fully leased up oil services companies, leased oil services companies. So these companies they do really well when oil is high, and they do fairly well when oil is low because these oil rigs, as you can imagine, need to be maintained regardless of the price of oil. Nobody wants to re-drill an oil well for millions of dollars when it just costs something to service it. So we don't deal with oil drillers because they're very boom or bust. But oil services is a very strong market historically. And so we were buying these like 20,000 square foot industrial buildings leased out to them with large acreage, 5 acres, 6 acres, 7 acres. So it leaves plenty of space for indoor storage, outdoor storage. And these companies love it. They have their offices as about 10, 15% of the building. So they can run their office staff through there. And it's a very solid play for us in Texas right now. So we're looking at several of those, and wherever we can structure a good deal with the right terms. And being new construction, it means CapEx is a minimum, risk is a minimum. Biggest risk is that they're single tenants, but most of these companies can be from $20 million revenue to $800 million revenue. So for them to pay 3, 4, 500,000 in rent is not a big deal for them. So we find that risk to be relatively low. How I can be reached, you can reach me through our website at beacon1capital.com. I'm available on LinkedIn, Instagram, Facebook, and just reach out to me.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.